we've caught up with the management of Happiest Minds, and Venkatraman Narayanan, who's the managing director of Happiest Minds, spoke to us. Here out a slice of that conversation. There's a lot of murmur around how while there was lack of maybe ordering activity or sentiment up till now, up till April, up till May maybe, things are at the margin changing. Companies are winning orders, even though these are short cycle deal wins, if you will, and that the sentiment will improve materially towards the second half. How are you gauging the landscape currently?
I would also echo with that sentiment, Niraj. See, what's happened is I've been always saying that you can't stay away from investments in IT for too long. Given all that's happened in the last, year, 12 to 18 months, there has been some bit of, I would say, pause on spend from the IT side. While it's starting to come back, it's not coming back the way it happened after COVID, but there is that a bit of release in budgets, and we are seeing, our pipelines are slowly getting full. Existing business, new business from existing customers is also showing a pickup in, there's a traction that's happening. We are also starting to see new business, new discussions around that. The last 18 months, you had geopolitical issues, you had, elections in the US, you had aspects of the uncertainty over generative AI or AI as a whole. So all of that is slowly, I won't say receding, but people are able to work and they've made peace with that, and they're trying to get back to business.
Okay. Okay, so is there a perceptible change right now, or are these early days and you might be trying, we might be trying to read a lot between the tea leaves, or is there a perceptible change and maybe it will start showing up in the way business comes in for the sector at large and maybe for you as well?
I think the sector at large, has been waiting for this turnaround. We are now, most of us are looking at a nice pickup in the second half of the year. Q1, Q2, pretty much you've been covering us and the industry for quite some time. The quarter is almost done, and Q2, whatever needs to be done is almost in flow right now. So you can't really change the events or the course of events of Q1 and Q2 to a great extent. So Q1 and Q2 is almost, we are on target or whatever we had set for ourselves. But talking about a pickup, the macro scenario, it's the second half of the year. Last Q3, Q4, we thought things would change, and there would be some bit of opening of purses, so people would come back to the spend, to the table to discuss stalled projects that, thanks to the border skirmish or whatever we can call about with what we had with Pakistan and the interest rate cut that happened at the federal level or in India, they were all, while expected, took time to materialize. Now they are all behind us, but now again, what's happening in East Asia. But while all of that, I'm giving as a, I'm not talking about them as a cover for how things will look forward when we look forward, but it's essentially looking better in the second half. That's a summary of it, Niraj.
Which is very, so by second half, you mean second half FY or second half calendar year?
No, we are talking about FY. So
FY, okay.
Q1, Q2, yeah.
Okay, so expectedly maybe from September or October onwards, things will start showing material difference.
That's what we are looking at. That's exactly what we are looking at.
Got it. Now, and while you will provide a revised timeline for that aspirational 1 billion target, and we'll wait for you to do it when you do. But while you mentioned that, and I didn't get a chance to talk to you during your numbers, but you mentioned about moving back operational metrics higher by 500 basis points over 2 years, right? FY 26, 27, you get back to 22% from 17.5, what have you. Now, is this already on road, the improvement despite the sluggish piece right now, or do you anticipate that with the second half momentum coming in is when your operational metrics will also start looking better?
Like I have said, as far as our performance was concerned, the drop from 20 21% to the 17.5, 17.8% that you rightly pointed out was primarily on account of the investments that we made in new business, the investments that we're making in GBS, and obviously some of the investments that we have now started making into the Artha banking platform. So these three combined, have to start paying off. Generative business services is now a year old. We are hoping to start breaking even this current year, and then it should start contributing positively to the bottom line. And given the way you have billing rates in that business, the kind of work that we do in that business, it should be fairly profitable. The way we look at it, on the operating metric standpoint, we should be better than what we do with the traditional digital services. As far as the new sales team is concerned, it's something which was put in place. It's beginning to start firing. You will start seeing there is a lead and lag effect for any salesperson or any sales team that you put in place, minimum of 6 to 9 months. That's also now slowly we're coming to the end of it, and we'll start seeing performance coming in, and that's some of the confidence we have going into the second half of the year that the new sales engine will start fire. The third thing is Artha Banking, which is a decent banking platform. We are making investments into it. It is today close to $7 to $8 million in revenues for us. If you have to take it to the next level and target higher numbers, you need to make that investment to make it digital ready, a little bit more integrated with the UPI and the likes, and a lot of things that need to be done to target the Indian banking sector, which is a key market place for us, market segment for us to target for future growth. So if you adjust for all of this, we should be fine with the 20-21% operating margin that we talked about earlier.